Friends, in this session we will understand debt versus equity financing. I mean whether the project should be funded out of debt or equity, or in which period it should be funded by debt and in which period it should be funded by equity. We'll go ahead. See, we know assets can be funded out of equity and debt, right? Now which financing should be selected? Is it equity or debt? Okay, before going ahead with equity, I'll tell you what are the benefits available out of debt. One is debt will carry low rate of interest if it is from banking channel, and the debt will also give you something known as tax benefit for your business. I mean whatever you pay as interest is a allowable expense as far as the income tax authorities are concerned. So your profit will come down to that extent and you will pay less tax. So there is a tax benefit, and cost of raising debt fund is simple and it is very low issuing and processing cost, unlike raising equity. So the debt funds has all these benefits, but understand the benefit comes along with the risk. What is the risk? In difficult times, if you are in stress, it is immaterial for them, for the people who have given you the money, you have to pay the interest and principal. So I have just mentioned about the debt. What about equity? Equity is the money which comes from the owners and it comes with a high level of expectation, but it can be fulfilled if there is a profit and it cannot be fulfilled if there is a loss. But debt is something different. Whether you make profit or loss, you have to fulfill the promise. We'll take some numbers to understand this even in a better way. So let me tell you, there is a scenario 1. There are assets worth 100 and these assets are funded by owners funds of 80 and debt funds of 20. I've given you the number as 100 so that we can talk in percentage also easily. So it's 80% equity funding and 20% debt funding. And now I'm going to give you the other information. Let's say it's a business unit and they have earned a profit before interest of 40. So now with this profit they have to pay interest on debt, right? What is the debt here? The debt is 20. The debt is 20. So on 20, let's say interest is 10%. So less interest at 10%, which is on 20 at 10% is going to be 2. So now you have profit after interest, or we can call it as profit before tax, which is 40 minus 2, 38. And let me give you the tax information. Let's say it's somewhere around 30% and it's going to be somewhere close to 11.5 to 11. So I'll have it as 11. So we'll have profit after tax, and which is 38 minus 11. So the profit after tax is 27. So with the available profit, we have paid interest now, we have paid tax, now it is a turn to pay the owner. So what is the profits available for owner? It is 27. And what is the investment of the owner? It is 80. So we'll write here the owner's investment or equity is 80. So the 27 on 80 is the return available for the owner, and it say it is 33.75%. So this is the scenario which we discussed, where the equity funding is 80% and debt funding is 20%, and the return available for the owners are 33.75%. Now I'll give you the scenario 2, same assets 100, but instead of equity debt of 80-20, here it is rather equity of, I'll make it as 50, equity of 50 and debt funds of 50. So instead of 80-20 combination, now it is 50-50 combination. Now we'll see how the return works for the owner. The profit before interest is same 40, but now interest on loan is at 10%. What is the loan component? Loan component is 50 now. So 50 into 10% would give 5 for us now. So instead of 2, they have to pay 5 now. They have to pay more interest. So the profit before tax is coming down from 38, it has come down to 35. And there will be tax on this profit, say at 30%, and it's close to 10.5. So profit after tax is 24.5. So literally in value terms the profit after tax had come down. But what was the investment of equity shareholders? It was 50. Previously it was 80, now it is 50. Now what is the return available for equity shareholders, which is 24.5 divided by 50? What it is now? It is 49%. So the return available for shareholders have increased from 33.75 percentage to 49 percentage. It's a whopping 15% jump. And why did this happen? This happened because of something called leverage effect. When the project funding pattern got changed from 80-20, when the project funding pattern got changed to 50-50, where the debt level was increased and equity level was reduced, the return available for equity shareholders have increased. So the leverage effect works because of debt, and this will work at its best during good times. So what does that mean? It will work in opposite direction during bad times. We'll understand this in next session.